This is video 3 in our series, Avoiding 3 Investment Pitfalls That Lie Ahead. But before we get into video 3, I hope you had a chance to view video 1. We discussed why Las Vegas, why now, and pointed out some of the investment options in Las Vegas real estate and why it could be right for you. In video 2, we went over some alternative investments and where real estate may fit in your overall portfolio. I think as we move forward in video 3, it's important to emphasize that if you avoid major investment pitfalls, you don't have that one big drag on your portfolio, the asset class that way underperforms. So oftentimes, avoiding pitfalls can be more valuable than finding that diamond in the rough. With that said, let's talk about our first pitfall, ignoring the effects of inflation. Inflation isn't just a word, it can truly erode your purchasing power. And while the last few years, due to the recession, we've actually had some deflation. In other words, inflation hasn't been here. We've had very, very little the last few years, and it's easy to ignore. However, the historic data will tell us otherwise. According to the U.S. Bureau of Labor Statistics, since 1914, average inflation rate is about 3.4%. And it's truly easy to pass off as no big deal, but if you were forced to pay 3.4% more in taxes, you'd be outraged, and that's what inflation is. It's a tax on everybody. Most economists anticipate this year will be between 2.5% and 3% on our inflation rate. Once again, it's easy to pass off as no big deal, but if you are like me, you can remember back to the 70s and 80s when the inflation rate was 12%. And at a 12% rate, here's how it erodes your purchasing power. In 6 years, your purchasing power is literally cut in half. Now, many are saying that will never happen again, but this chart I bring up illustrates how it could. This chart clearly illustrates the diminishing purchasing power of the dollar. A 1971 dollar, when the chart began, is only worth slightly less than 20 cents in 2009. And if you want to argue that inflation is not going up, just look at the red line. This represents the increase in the money supply. Inflation is clearly headed north. And that doesn't even take into account the last 3 years in which the money supply has increased more dramatically than ever in the history of our economy. Okay, just one more little nugget before I get off my soapbox on inflation here. Also to consider is that inflation statistics do not include energy or food. The government, in their infinite wisdom, decided this would not be indicative of the overall economy. I don't know about you, but I still fill my tank up. I still really like to eat. So I hope the takeaway for you is that you consider how much inflation can impact your purchasing power and ask the question, how does this investment protect my purchasing power? And if the answer is true, it's only through purchasing tangible assets that you can protect purchasing power. Let's move on to pitfall number 2, playing it too safe. People tend to play it too safe when they are fearful of losing their money. And let's face it, with all the volatility we've experienced, it's understandable that people would be fearful. So what do people do when they're afraid? They hide their money in cash, they hide their money in their checking account, in CDs, and in government bonds. These types of investments have been fine the last couple of years with a zero inflation rate. However, looking forward, even the Federal Reserve Board admits the inflation rate is likely to be 2 to 3% the next few years. And many leading economists say the inflation rate could jump as high as 7%. Please avoid a negative return, invest in ways that will protect you, and don't play it too safe. Let's talk about pitfall number 3, ignoring systemic risk. Well, what is systemic risk? It's when the entire system breaks down, like it did in the 1930s, and again to a slightly lesser extent in 2009 with the financial collapse. All asset classes, the entire economy tanks. Systemic risk can come from a number of sources, such as abroad. Recently, Greece sneezed, the euro caught cold, and the Dow Jones Industrial Average dropped over 400 points in one day. Just because the good citizens of Greece decided they want to retire at 55 years old and the rest of Europe didn't want to fund it. Systemic risk can come from random acts of terrorism and rogue governments. It can happen like it did in 9/11 when planes flew into buildings, the buildings crashed, the market crashed, and our government did all it could to bolster confidence. But since there is no way of predicting the future, any source of systemic risk is just around the corner. But perhaps the greatest source of systemic risk comes from Wallington. I'm not talking about Wallington, England. I'm talking about Wallington, the merger of Wall Street and Washington. When the Treasury Secretary is a former Goldman Sachs CEO, that's Wallington. Wallington is what happens when congressmen and senators are bought and paid for by lobbyists from the financial institutions that benefited from the bailout they voted for. This is Wallington. And if you believe Wallington will solve your problems, you're dead wrong. Wallington is making your problems just as sure as they are making and printing more and more money. Wallington is here to stay, and so is the new order of financiocrats that's upon us. Financiocrats, in case you're wondering, they're the people who are in the financial services sector and become bureaucrats, or the other way around, like a certain presidential candidate who actually lobbied for Freddie Mac and Fannie Mae. This is not an indictment of an individual, but of a system that is corrupt to its roots. If you rely on Wallington and the financiocrats to help you out of this mess, you're looking the wrong direction. We've all seen and experienced the wide swings of stock markets and bond markets the last several years due to the effect of Wallington, rogue nations, and random acts of terrorism. So then, what can we do to eliminate this systemic risk? What can we do to shore up our portfolio for future unforeseen events? How about investing right here in Main Street instead of in Wall Street with at least some of your portfolio? There is no way to eliminate systemic risk entirely. However, exposing yourself